What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome. Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined by Adrian Day, the founder of Adrian Day Asset Management and portfolio manager at EuroPacific's Gold Fund. Adrian, how you doing?
Well, I'm fine, thank you, and thank you for asking me back.
Yeah, it's good to have you back. We last caught up in November and had a very positive response to our conversation. So I'm excited to share your perspective again, because even in a few months, tons has changed. And, why don't we start there? Let's start with the U.S. government administration. Looks like we've got a Democrat-led government. And does that impact your gold thesis for 2021, 22? And the near term?
Yeah, no, I think it's very significant, frankly. Now, you have to understand it's 50-50 in the Senate, it's 50-50 with the deciding vote cast by the vice president, who's obviously will be Democrat. But when you're 50-50 with one deciding vote, that means that means you can't afford to lose very many of your own supporters. So to me, what that means is that some of what we'll call the more extreme proposals probably will not get very far. The Senate, both Republican and Democrat, the Senate historically has been a body where it's easier to get, we'll call them defectors from one party to the other, if they feel that the administration is moving too far in one direction. So I think, it's not as though they have a 60-40 majority or something, which will be completely different, but they do control it. So that clearly means, that spending is going to be easier than if the Republicans retain control of the Senate. So that's a very, very significant thing, because if the U.S. steps up its spending, as we know, most spending, certainly in the last couple of years, has been unfunded spending, meaning, we're not collecting taxes for the spending. We're not even borrowing the money. We're just creating the money out of thin air. In fact, right now, if you look at what we'll call the untouchables in the U.S. budget, which are interest on the government debt, transfer payments, I nearly called them welfare, that's probably politically incorrect, and defense spending, those three, which are the big ones, of course, but those three things, they're already 150% of the tax collected. So tax isn't going anywhere close to paying for what we have at the moment, let alone what's coming down the pike. And if the Fed continues to create money out of thin air, that is very, very bullish for gold. Extremely bullish for gold.
Okay, I'm with you there. Now, so following that thread, there's a couple of questions I want to ask that sort of spin out of that. Number one, if this gold market and precious metals market continues to heat up, the risk factors for retail investors increase alongside, right? Because more companies enter the space, expenditures get more frivolous, there's more landmines for us to step on. And so, we always talk about how to pick a winner. You can only do that if you avoid the losers, right? And so what are some common mistakes, Adrian, that you see retail investors make when a bull market is emerging in the commodity space? You've been in this game a long time.
Yeah. Well, first of all, I think it's important that we recognize as gold investors, gold stocks are inherently volatile, even in the best of times. You only have to look at, say, Franco-Nevada and look at, the drawdowns that's had over the last 10 years. So it's an inherently volatile sector. And at the same time, it's inherently risky. Risk and volatility are two different concepts, of course. Risk is the permanent impairment of loss, and risk is a temporary impairment. Volatility is a temporary impairment. So it is more risky as well as more volatile. And I think if you're investing in gold stocks, particularly in juniors and exploration stocks, you are going to have losers. You simply cannot avoid it. Anyone who's been in this business 10 or 20 years says they've never had a loser. I don't know what they're investing in. or smoking. So you are going to have losers. So the question, of course, is partly how do you pick right stocks to begin with and try to avoid losers as much as possible. And then the other side of that question is, what do you do with the stocks that don't do what you expect them to do? But in the first part of that question, I mean, to me, the most important thing, which, I keep coming back to, is to stick with good people. And, people who've been around a long time, everyone's got to start out somewhere, of course, but people who've had experience at other companies, people who have good reputations in the business. And once they're running their own companies, people who simply do the right thing, do what they say they're going to do, don't waste money, et cetera, et cetera. And I think if you stick with the right people, to me, the people are so much more important in exploration than the projects. And I've said this before, because good people will be able to raise money and will know what and will get rid of bad projects and will be more likely to find good projects. Bad people can, I don't care how much money they have, they can waste it and they can destroy a good project. So people are the most important thing. And you're absolutely right, Jay, as the market develops, we'll see more. I mean, at the moment, I think we're on pretty good ground. We all know a few stocks that we might want to avoid, but we're on pretty good ground, especially, say, the seniors are being very disciplined in their spending. But as the market develops and the shortage of projects becomes even more critical than it is right now, for companies who are producing 2, 3, 4, 5 million ounces a year, slowly seeing those reserves deplete and not replacing them, I think, we're going to start seeing some of the old failings come back, frankly. Sure. But particularly for the senior stocks, we're a long way from that at the moment. Okay. And the juniors too, frankly.
Yeah, sure. Well, there's been a bit of a disconnect so far between the price appreciation of the commodities and the miners to a degree. And I want to talk to you about that a little bit. But beforehand, I want to get your thoughts on, your forecast for M&A activity in the sector. And, one factor that I've been sort of curious about is our lack of travel, due to obvious restrictions impacting the frequency of M&A because we can't get out and look at projects. We can't do the diligence required. And when these restrictions are lifted, do you think there's some pent-up demand? And do you expect that to pick up in 2021? And for that,
yeah, absolutely. Once the restrictions are lifted, and I've had this from many CEOs of companies, large and small, who aren't telling me specifically what they're about to buy, but they're telling me there's a lot of companies, projects we really want to take a deep dive on.
Interesting.
But until we can, we're just not doing anything. So I think there's definitely a lot of pent up demand. And, you look at a country like Australia, for example, which is closed, and it's closed even between the states. Now, some companies are comfortable hiring a local consultant to go and look at things. You've seen that, with a couple of recent, you've seen that with some recent royalty acquisitions, for example. So you have a local person that you trust, but he's still not an employee. He's still not directly responsible for you. Canada is also difficult, and Argentina is impossible, et cetera, et cetera.
Right.
I think once those, and we're not close to that, I don't think. I think we've got several months of that before people can travel freely to countries like Peru and Argentina and Australia. But at that point, I think I'm not sure that there's very many deals where they're about to sign on a dotted line once they've looked at the project. But I think there's a lot of deals in the works. But being able to go on site is going to move along. So by the end of the year, we should be seeing quite a pickup.
Now, can I convince you to speculate a little bit, Adrian, on any projects, companies that you think are ripe for takeover?
Yeah, I'm going to skip that question, and I'll tell you why. I very, very, very rarely buy a stock or company simply because I think it's going to be taken over. I will look at companies that have, that aren't about to blow up because of a management or anything, but have good quality projects that don't have, big red, don't have anything like environmental or social license against them. And if you buy good quality projects which are undervalued, then clearly they're more likely to be taken over.
Right.
So that's the way I approach it, to be honest. I don't really look at it the other way around. I mean, I think there's several that sort of should be taken over, if you know what I mean.
Yeah. As a general rule of thumb, are you leaning towards scale in that conversation? Which projects are more likely to be appealing to a major?
I think initially we're going to see more of the large scale. We're going to see the seniors are going to try and do mergers of equals, and that means larger companies, obviously, by its nature.
Right.
Or they're going to acquire specific projects. Yeah, definitely. But we're looking at larger projects, and we're looking at projects that are already in production from companies who perhaps want to get out of a particular geographic location, or want to rationalize their own portfolio or something like that.
Okay.
I think that's where we're going to start to see it, definitely. Then we're going to slowly move down to more deals like the Equinox Premier. Now, let's face it, Equinox is a pretty unique company when you think of who founded it, and the goal and vision that Ross Beatty has, and his demonstrated ability to execute.
Yeah.
But I think as time goes on, we'll see more companies of that size start to look for acquisitions. And of course, when they make acquisitions, by its nature, they will tend to be slightly smaller than what Barrick's looking at, or what Agnico tends to do. I mean, that deal with TMAC was a sort of a perfect Agnico deal, a tuck-in in a place they know, where they can execute and maybe a lot of other people can't, so they don't have to pay a huge premium to get it. Yeah, but definitely we're going to see more of it.
Okay. Now for 2021, do you think, who's going to shine this year? Typically when the sector begins to heat up, we see a lot of activity in the royalty space. It's a great way to enter the sector, especially if you have limited experience, decreased downside risk. You still get some of the upside. Start with the majors maybe. And then eventually, as the market matures and your experience increases, look at the exploration companies. What do you think is going to stand out in 2021?
Yeah, I think two things are. First of all, despite the fact that this bull market, gold really bottomed, beginning of 2016 and to 2015. So it's not as, it was slow for a while, of course. But to me, the seniors are remarkably undervalued right now. So I think when gold recovers from this little blip and starts moving back up, in the first few months of this year, we see gold at 1950, 2000. Most of the senior producers and senior royalties, which have really lagged, they've lagged considerably. I think they're going to take off.
Now, why do you think that is? There's been a bit of a disconnect between, the commodity price and the miners.
No, absolutely. And it shows up more in the big cap stocks. I think that's because, more generalists are obviously buyers of things like Franco-Nevada and Wheaton and Barrick and so on. And, gold was so flat to down since the peak in July. I think over the last 6 months, it's just kind of worn away at some of these people's, patience. And they are more likely to sell quickly. The generalist is more likely to sell quickly. The fund manager, who perhaps has a, big cap global fund and added 2 gold names, well, when they don't perform, he's just going to get rid of them. His Tesla's doing okay, and the things he really knows and he really likes, they're doing wonderfully.
Yeah.
What am I holding these stocks that I don't really understand anyway? Someone persuaded me to buy them, so they sell them. But when the gold sector, when gold starts moving back up again, I think generalists will come back, and they will go to Barrick and Newmont and Franco and so on first. So I think that's definitely one sector that we're going to see move. And I think that's going to move first in the next several months. At the other end of the spectrum, I think you're going to get very, very selected exploration stocks that either have, a discovery or have very, very good, promotion behind them. And promotion doesn't have to be bad. I'm just saying they have a buzz. I think we're not necessarily, I don't expect to see the whole exploration sector move strongly anytime soon, frankly.
Yeah.
And I think a lot of investors are going to look at, stock A, stock B, and they might say, well, it's got good management, it's got a decent balance sheet. Yeah, it's okay, but nothing's happened for 6 months or 6 years. Why am I holding this when the market's moving? So I think you're going to get people moving in the juniors. They're going to move very much to things that are, happening, as it were, where something's happening.
Yeah.
But those are the two areas I think we're going to see big movement.
Yeah. Okay. That's interesting. Now, to play devil's advocate, what could prove that? So I agree, the gold sentiment and the miners. What could prove us wrong, though, Adrian? If we look at, there's going to be record money printing again this year. And yes, that debases the currency. It's a strong case for gold. It's probably also going to push the broad market to fresh highs again, which captures people's attention. There's all sorts of alternative investments these days as well. Like you can hedge your bets against USD by investing in Bitcoin or cryptocurrencies. Is there anything on your radar that could change your bullish narrative on gold right now?
Yeah, I think if we look ahead, say for the next year, I think certainly the vaccine rolling out in most major countries, perhaps more rapidly than we're thinking, okay. But more importantly, what that would lead to. If that leads to economic restrictions being lifted sooner and more completely, that's important too, more completely than we think. If a restaurant in Puerto Rico is now allowed 40% capacity instead of 30%, that doesn't move the needle very much,
right?
Except for that. So I think if the economy comes back globally much more rapidly than we think it's going to, and consumers react by, getting on planes and doing things and economic activity, along with that, the dollar rallies and interest rates pick up. Now, I don't think the last two are going to happen. So if you have a very strong economic recovery driven by strong consumer demand, people get back on planes much sooner than we thought they would, and the planes are all full, restaurants are all packed, etc. Unless the dollar rallies and interest rates pick up, I think that's going to be very, very bullish for gold.
Okay.
Very bullish, because you'll start to see consumer inflation numbers that have been missing. But to answer your question, I think a strong economy, interest rates beginning to move up, and a stronger dollar would all derail gold.
Okay, so yes, negative correlation to gold, but then what's the play there? You could say in that case, then let's look at base metals. Let's look at copper, maybe silver for its industrial uses. Where do you go in that scenario? Sure.
The base metals are not going to do well, or then a strong dollar and rising interest rates are not a positive for base metals, right? So they will do well in a scenario of a strong economy.
Yeah, right.
But if you see a rising interest rate, that's not going to be good for base metals either.
Okay.
I think a lot of the base metals, frankly, since you touch on that, have maybe moved a little too far, too fast.
Interesting.
I'm a big bull on, as we've talked before, on things like copper and nickel. But I think now the market is perhaps looking just a little bit too far, into the future.
Okay.
But anyway, yeah. So I think the base metals will do well if you have a strong economy, particularly strong Chinese economy, so long as interest rates don't move up too much. The base metals can tolerate higher interest rates than, say, the gold market can. Because once you flip from negative real rates to positive real rates, that's a big negative for gold.
Yeah. Do you see that? I mean, how realistic, in your honest opinion, is that likely to happen?
I don't think it's likely in the year ahead, frankly, with all the money printing. I mean, if you look at not just the Fed, but you look at the Fed as well as, well, look at what Canada's done. Their stimulus, I think, is per capita one of the largest in the world. You look at what Britain's doing, the Bank of England's talking about, they're studying negative rates. And, the Chancellor, Sunak, who says he has a picture of Gladstone on his wall because Gladstone was such a fiscal conservative, but he's handing out money like he's a drunken sailor. You've got the ECB, where they're not even talking about cutting back. And Powell, Jerome Powell, the head of the Fed, in his big press conference last month, I mean, he was as dovish as he ever has been. And he said that interest rates are going to remain low for the foreseeable future. And I don't see why we shouldn't take him at his word.
Right. Okay.
I mean, I think the more difficult decision will be when the Fed says we're going to start raising rates and shrinking the balance sheet. Then the question will be, do we believe them? But when they say we're going to continue printing money and we're going to keep rates low, I don't think there's any reason not to believe them.
Okay. Yeah, I'm with you. Now we've spent a lot of time on gold. I mean, we touched on copper and like what, seven year highs at the moment. But Adrian, if you had to pick one commodity from three, being copper, silver, and uranium, right, top performer in 2021, which one do you go with?
I think gold, as I've said before, this is not new. Gold has the best risk reward at the moment.
Sure.
But if we get a strong gold market, particularly one that's accompanied by economic growth and the signs of inflation, then silver is going to do much better. Silver tends to act as a monetary metal. If you look back over the last 20 years, it tends to move much more with money supply and the credit cycle than it does with the economy. But nonetheless, some of the fundamentals about silver are really quite interesting. I mean, you look at the silver supply that has been shrinking for the last 10 years, and it was down last year on the year before, and 2019 was down on 2018. That's pretty significant when you consider that you didn't have the same scenario, in gold. In a strong market, I think silver will outperform.
Okay. And are you watching the Iranian market at all? Any thoughts?
I know people are going to hate me for saying this. In the near term, and by near term, I mean the next year or two, there is sufficient supply of uranium in the wings. So that if we see the uranium market go up 20, 30, 40% and hold those levels, at some point, Kazakhstan can step up their production and exports, and Cameco can resume production at MacArthur and Cigar Lake. So, it's an artificial shortage that we've got in those metals in the short term.
Right.
Because if you look at copper, copper could double from here. And it would be very, very difficult to increase the copper supply meaningfully in anything like the next couple of years. You just plain couldn't do it, physically couldn't do it. That's not true of uranium.
Okay. I'm going to pivot a little bit just to some basic investment advice, Adrian. If we are, we've made some smart decisions in the market and achieved some capital gains, I find that the harder part of the trade is selling. We spend all of our time talking about what to buy, when to buy, how to buy. Rarely ever do we talk about how to sell. And I lose more sleep over that than I do over buying. So any life experiences that you want to share with our audience when it comes to you're staring a gain in the face and debating your next decision?
Well, first of all, if you have a plan, I think it's important that you stick with it unless something is dramatically different. In other words, you've heard of people who say, Casey, I think was the first one that talked about the Casey free ride. When a stock doubles, sell half of it and it's a free ride. I don't follow that philosophy, by the way. Okay. But if that's your philosophy, that at least I think it's important to stick with it. Some people use trailing stops. Now, I don't like stops in gold stocks or any commodity stocks, frankly, because they are just so volatile. And I mentioned Franco-Nevada before. I mean, I could pull up the graph, but Franco's the biggest, right? And the best and the most conservative. But Franco's had drawdowns to 30% and more over the last 10 years. Now, where do you put your stop? That's the question. In what I call a normal market, you can say, let's put a 5 or 10% stop. Keep my losses reasonable. Yep. But if you put a 10% stop on gold, you'd be out of every single one of them, almost every week.
Yeah.
And if you make it, someone I know said, well, I use a 50, he only invests in exploration stocks. So I always use a 50% stop. Well, his rationale was that if I lose 50%, I know I can get a double at some point. But if I lose 60 or 70 or 80%, getting 200 or 300% becomes more difficult. So 50% is his. But, do you really want to say I'm going to sell these stocks for 50% loss? So I don't like stops. I don't like stops, particularly as stop losses in the gold market. Now, I'll use stops as protect profits, which is something different from stopping losses.
Yeah.
And I do that when the stock clearly has momentum. It's really moving. Maybe the market's strong, but this particular stock is really on a roll and the volumes are good and everything else, but I just think it's grossly overvalued. We'll put a stop in to protect the profits. So the way I do it really is I really look at fundamentals, which I know is much more, is subjective. It's not a rule. It's not objective, but I look much more at fundamentals. And I have a couple of principles, if I may. One is I divide my portfolio. It's on a continuum. It's not a black or white, but it's on a continuum between my core holdings at one end and my speculative trades on the other end. And with the core holdings, things like Franco and Agnico, I'm not going to be concerned if they drop 10 or 15 or 20%, so long as I'm still bullish on the gold. At the other end, I will be very, very quick to take profits, and I will use stops. And so that's one thing. The second, so at least you're dealing with part of your portfolio, but remaining exposed. The second thing, frankly, is if a company doesn't do what it promises to do and doesn't have a strong reason for it. Now, of course, in the exploration business, things are always going wrong. I mean, you can't help it. In fact, was it Robert Friedland who first said Murphy works overtime in the gold business? I mean, anything that can go wrong will go wrong. And that's true of the biggest producers and the smallest exploration companies. But you have to be disciplined. If you bought a stock because they're about to do a drill hole program on this very attractive project where they had one nice drill hole last summer and now they're about to put 10 drill holes in, and you're expecting whatever. You're expecting this to prove up the core, and you're also expecting at least one of their step outs to be attractive, and it isn't, then you have to sell, to me. If it goes wrong, even if it's not the company's fault, if it goes wrong, I'm out. If a company says we've raised X amount of money and we don't need any more money for the next 18 months, and then 3 months later they raise money and they say, oh, well, this investment banker offered it to us, so hey, we took it. I'm out. So I'm very disciplined on that.
Okay. Yeah, no, I appreciate that. And I see your hard, fast rules, and thanks for sharing. Okay, Adrian, look, it's been awesome catching up with you and getting your perspective on a couple new things and some forecasts for 2021. Thanks for coming back.
Well, thank you so much for having me. Thank you.